A warm welcome to you, my dear children. Welcome back to the accounting part of your syllabus. This is the fifth lesson, lesson number 5, unit 5, and we are ending unit 5 in this session. Right? So, in your textbook, I told you in the previous session, children, that this is the second accounting lesson. First one being an introduction to accounting, and the second, this lesson that we are ending today, that is accounting equation. So, unit 5, accounting equation, the last session to finish it off. Students who watched the previous sessions, you might remember that we learned about two versions of the accounting equation. First one being the most simplest version of the accounting equation. Simplest version. Simplest. When I say simplest, you must understand that it is not often used. It is not often used, but useful to remember. That equation, the simplest version, was, if you remember, it was assets equals equity. Assets equals equity. And I very clearly told you that this equation is possible. It is possible to apply only for a business which has no external liabilities. This equation is only possible when the business has no external liabilities. In other words, all the assets in the business, belong to the owner. So, assets equals equity. But then we learned that equation, the accounting equation with liabilities, how it is formed. With liabilities. And that is what given here. That is what is given here, as you can see. Children, I told you even before, this is the most common equation. This is the equation which is mostly used. Even in your papers, in your exams, this equation is the one which comes most of the time. Sometimes you will have to use this one, sometimes. But most of the time, this equation is used. All right. So, with liabilities, the equation, we call it the basic accounting equation. Right? The basic accounting equation. It is useful to remember it will be useful for you to remember that this equation is not the only version of the equation. It's not the only version of the equation. This is the mostly used version, commonly used version, but there are other versions. That is what you are going to learn today. Okay, first of all, we are going to learn another version of the accounting equation. Right, Let's look at the heading, shall we? Calculating the equity. Calculating the equity using accounting equation. Right, that is the heading today. We are going to start with this. We are going to calculate equity using the accounting equation. How does it happen? Well, you're going to learn now. Children, equity is always mentioned on the other side, on the right hand side of the equal mark, which means assets of the business are formed when equity gets together with liabilities. All right, we have discussed these things. Assets means the total assets, all the assets in the business, all the assets like the land, the building, the motor vehicles, the machineries, the furniture, the equipments, the fittings and the other partitions and everything which are in the business. So when we say assets, you must remember that these assets represent total assets. Total assets are formed with what the owner has invested, that is equity, and with what we have borrowed, that is liabilities. All right, this thing we have discussed already. So in the previous session we applied this equation, we used this equation, okay, and we did several exercises and we practiced how to calculate if figures are applied, how to calculate sometimes assets, sometimes equity and sometimes liabilities. How to calculate if figures are applied. Can you remember? Don't tell me that you don't remember. We learned how to calculate sometimes assets, in some instances equity, and in some instances liabilities. How to calculate if figures are applied. Just to remind you, if assets are given as 10 and out of that equity is 6, how much of liabilities must be there? And it is such a simple thing. We know that liabilities must be 4. Okay, when this gets together with liabilities, when the equity 6 gets together with the liabilities, it forms the total assets, right? Such simple things. But there is a way that we can apply or we can use to calculate equity using the equation. Okay, we change the equation in this manner. What we do is we take the equity onto this side, right? So if I clear the screen. All right. Now that we have a clear screen, we have assets equals equity plus liabilities. That is the common version of the accounting equation. Assets equals equity plus liabilities. What we do is we take equity onto this side. Then assets goes to the other side. The equation changes to assets minus liabilities. Assets minus liabilities. Equity equals assets minus liabilities. In a more practical manner. In a more practical manner. I'll show you how equity becomes equal to assets minus liabilities. Equity becomes equal to assets minus liabilities. Right. Now children, if this is a business, if this is a business organization, if this is a business organization, the building, this let's say this is the shop, this shop is invested by the owner. Shop is invested by the owner, right? The owner is right here. This is the owner. Owner is right here. Owner has invested this building. Owner has invested this building. This is his building. He has invested to the business, right? So building is the first asset of the business, which invested by the owner. Yeah, invested by the owner. I'll take these figures to the accounting equation, okay? Assets equals capital plus liabilities, or equity plus liabilities. Equity plus liabilities. E plus L, equity plus liabilities. All right. Then when the owner invested the building, let's apply a figure for the building. I mean, let's apply a value for the building, right? The building is worth, let's say the building is worth 100. The building is worth 100 rupees. Just for an example, we'll use simple figures. The building is worth 100, okay? Okay. Owner invested the building, which means 100 worth of an asset, which is the building, came into the business. And it was invested by whom? The owner. It was invested by the owner. That means every transaction must have two impacts now. We learned that every transaction which happens in a business must be entered under the accounting equation in two places. That is a rule. Well, without saying rule, I'll say that is the tradition. That is the accounting tradition. Every transaction must be entered twice. In that case, the 100 worth of building, which was invested by the owner, becomes the first asset of the business. This is the first asset, the building. And since it was invested by the owner, it must go under equity too. So under equity also there's 100. Okay, right. Then well, nobody can just start a business with an empty building, right? What are you going to sell? Let's say the building which the owner invested, it was invested to start a phone shop, a mobile phone outlet. Now the owner does not have any money to buy the phones, to buy a stock of phones. So he takes a bank loan. He takes a bank loan. Let's say the bank is here. He takes a bank loan. Bank provides a loan of 50. Bank provides a loan of 50, right? With the 50 he can buy a stock of phones, and he can display in his shop and start to sell the phones in a very simple manner, very basic business concept, right? With the 50 he can buy the phones, the initial stock, the initial stock of phones. Why did he take this 50? Because he did not have money. He did not have cash at hand. This 50 becomes a liability because it's a bank loan. It is a bank loan. How to record this 50 bank loan obtained for the business under the accounting equation? Tell me. How to record this 50 bank loan obtained? Easy, right? 50 first goes under assets, because whoever provides the resources are assets for a business. No matter whether it is provided by the owner or whether it is provided by an external party, these are assets for the business. So 50 also must be under assets. All right. Let's say this 50 is cash. Cash asset increases. On the other side, there is no change to the equity. It is 100, but liabilities has increased because it is a bank loan. Because it is a bank loan, liabilities has increased. All right, clear, easy, isn't it? Easy. Now I want to get the totals after all these things are done. Now the owner can go on with his business. He has a shop building and he has money to buy the stock of phones which he is going to sell. I'm going to wind up this equation at this point. And what I'm going to do is, I'm going to take the totals. How much of total assets here? If you take the assets column, how much of total assets are here? 150, that is 150. 150 total assets. How much of equity is there? Tell me, what is the value of equity? 100. Well, there's no calculations, it's 100. And how much of liability is there? What is the value of liability? That is 50. All right. All right. Now, if I ask you to calculate the equity, if this column is not given, I ask you to calculate, I ask you what is the value of equity of this business. What you do is, what you will probably do is, you will take the total value of assets, that is 100 worth of a building and a cash balance of 50, a loan of 50, right? So you have total assets of 150. From that 150, you remove what is taken from outside. You remove or you take out what is borrowed from external parties, that is the 50. That is the 50. So what this 50 is, you already know, the 50 is liability. Then assets minus liabilities becomes, equal to equity. Such a simple thing, right? Such a simple thing. All right. Well, it's like explaining to smaller grades. It's such a simple thing. There is no explanation needed. But just to clear out any doubts, if anyone had, I did that explaining. All right. There you go, children. Equity equals assets minus liabilities. That is how you calculate the equity. All right. Moving ahead. Now, how to record opening balances in the accounting equation? We step onto a new part. How to record opening balances in the accounting equation? You must be wondering what these opening balances are. What are these opening balances? What is meant by opening balances? Any idea? Opening balances. Children, in your examination paper, in your exam paper, you might get, probably you might get a question from this part we are learning. You might, there is a huge chance of getting this type of a question from the accounting equation part. When you get that question, first of all, even before you start to do the question, there is something you must notice. Something you must notice. Notice on the paper in this question. What you should notice is, when you read the question, children, notice whether the business given in the question is a newly started business or is it an already running business. You will get a question in this manner. Bimali started a business on 1st of January 2000 whatever to sell fresh vegetables. You're going to get such a question, okay, with a case, Bimali's case. in that question, first you notice, children, remember, first you notice whether this business is a newly started business or whether it's an already running business. In this case, in this point, we learn if the business is an already running business, okay, the business has been running for a period of time, to start a new accounting year or in a new year. How to record the opening assets, how to record the opening liabilities, and how to record the opening capital, how to calculate the opening capital, or opening balances in Sadamini's business on 1st January 2020 are given below. If you get the question in that manner, which means, it means, children, this business is already running business. The business is like, it has been carried out since many years and you are starting a new accounting period, or it's a fresh year. It is a new year. That is what they mean. Not like Bimali's case. Bimali started a business on 1st January. That means Bimali's business is started on 1st January. But this business, Sadamini's business, has been going on for many years. And this is 1st of January of 2020. Alright. In such a case, children, 2020, in such a case, you must know how to record the already existing assets and already existing liabilities of the business. How to record already existing assets and already existing liabilities under the accounting equation. Well, that is what we are going to do here. Alright, is that clear? Let's read through the question. Following balances were extracted as at 1st September, no, August. 8th month is August, right? 8th month is August, so 1st August 2020 from Sadamini's business. This is Sadamini's business, children. Sadamini's business. Sadamini must be a grocery shop owner or a retail shop owner. You know, by looking at the question, you can guess, right? It says following balances were extracted. Following balances means these balances. What balances do we have? We have assets. First we have furniture. Second we have stocks. Third we have debtors, and we have cash at last. Not only assets, we have liabilities. I'm always using red color for liabilities. I don't know whether you like it, but I'm always using red color because liabilities are sort of a risk, and red is for risks. No, red color is always used to, you know, to show danger. That is why I always use red for liabilities. Liabilities are liabilities, like risks. They must be paid back. And we have these liabilities: bank loan, creditors. Before going to our transactions. These are transactions. Before going to the transactions which has been done in the first week of August, before even looking at these transactions, we'll see how to record the opening balances. All right, are you ready? Let's get to it. Opening balances, how to record. Children, you must remember that the equation can be used in any manner. Even the second version of the equation you can use. Okay, but most of the time the equation will be given, the version of the equation will be given with the question like this. Even in your examination, even on the paper, to use which equation, that will be given. Which equation to use for the question, for your answer, that will be given. So in this question, the equation is given in this manner. Assets equals equity plus liabilities. The other version is equity equals assets plus liabilities. The other version which we learned earlier, like now few minutes ago, equity was here, equity equals assets plus liabilities. No, no children. I do this purposely. I say something in a wrong way. You must notice that. It's up to you to notice that. Now correct me. You correct me. If the other version of the equation is used, the other version is what? Equity equals assets plus liabilities? No, assets minus liabilities. That is what we learned. We are talking about this one. Equity equals assets minus liabilities. All right. Now, we are not using that equation, children. We are using the common version, that is equity. No, that is assets equals equity plus liabilities. Okay. Now, looking back at the opening balances, these balances were available at the on the 1st of January. On 1st of January in Sandhamini's business, we had right now we have furniture worth of 300,000, stocks worth of 200,000, debtors worth of 100,000, and cash value is 200,000. We are going to record the opening balances in the accounting equation. You must have the table divided into columns by considering what assets you have. We have furniture. Yeah. We have stock. Yeah. We have debtors and we have cash. Now it's just a matter of writing or mentioning the given balances in the first row. The first row is dedicated for that. See, opening balances. So let's just write down. We have furniture worth of 300,000. We come to the answer. And under assets, we have furniture already mentioned, 300,000. Let's go back and see stock. We have stocks worth of 200,000. Let's just mention the figure under stocks, opening with 200,000 worth of a stock. Starting the business on 1st of August. Starting the business on the 1st of August with 200,000 worth of stock. All right. Going back and let's get the next asset. Debtors 100,000, cash 200,000. And we'll mention under debtors 100,000, under cash 200,000. Done. We recorded the opening balances of all the assets. Right. Furniture, stock, debtors and cash. Now let's see what liabilities we have. We have liabilities, first bank loan, that is 300,000, and we have creditors 100,000. Well, you see that it's already divided. Liabilities section is already divided to bank loan and creditors. What was the value of the bank loan? 300,000, right? And the value of creditors is 100,000. There you go, done. Opening balances recorded. Check whether the amounts are correct. Bank loan 300,000, creditors 100,000. Done. 300,000, 100,000. Finally, we can move on to the transactions and record the effects of the transactions, the impact of the transactions. We are starting the transactions. We kick off the transactions with one thing in mind. Everybody, you all, my dear students, you should have this in your minds. What? Have it in your minds. Every transaction must have two entries, an increase or a decrease. Okay, every transaction figure or a value of a transaction must be entered in two places. Okie dokie. Let's start with the first transaction. The following transactions occurred. Right. First transaction. Purchased goods at 100,000 to sell. Purchased goods at 100,000 to sell. I told you that Sandamini's business must be a grocery store or a retail store. Remember? So in that business, 1st of August, she started trading, and the very first transaction was this. What? Purchase goods at 100,000 to sell. In this instance, create a picture in your heads. Create a picture in your heads. We are getting goods. Remember, you are not Sandamini. You are not the owner. If you consider yourself as the owner, you can't do this. You're going to go wrong. You are not the owner. Owner is a separate person. Okay? When you are recording the transactions, you must consider yourself as we must consider ourselves as accountants, not as the owner. Yeah. Then let's look at the first transaction. Purchasing goods at 100,000 to sell. We are getting goods. A stock of goods. Okay? We are getting a stock of goods into the business. Isn't that an asset for us? Business is getting an asset, right? Which asset? Yes, the asset of stock. At the same time, assets just don't fall from the sky, Goods don't fall from the sky. You must purchase. That's what it says here. We purchased. That means money, 100,000 should be paid. In that case, goods came into the business and cash went out of the business. Both are assets. First transaction. Goods means stock. How much of stock? Goods worth of 100,000. Right, so goods increase 100,000 and cash decrease 100,000. Done. You got it, right? That's how you do it. If that minus mark is not properly done, okay. Now it must be clear. Cash decreases 100,000. Next transaction, number 2. Sold goods which were purchased at 100,000 for 125,000. These goods which you purchased, it's these goods that you purchased. These 100,000 worth of goods which you purchased, which we purchased, we sold for 125,000. Sold for 125,000. That means with a profit. We sold goods with a profit. It's a profitable transaction. Now, again, what you should have, the picture that you should create. What is the picture? Goods going out. Now goods going out. This stock of goods going out. Cash coming into the till. Right, good. So, sold goods which were purchased for 100,000, for 125,000. Goods were 100,000. Value of goods is 100,000. Decrease because goods are going out. Stock minus, goods decrease. Cash coming in, how much? Cash coming in 125,000. Cash coming in 125,000. That's why I put plus mark. Cash increased by 125,000. But it doesn't stop with 2 entries. It doesn't stop 2 entries. Because there is a profit, children. There's a profit. There's a profit. And there's something else you should notice. This is the equation mark. I mean, this is the equal mark. Assets equals. Assets should be equal to equity plus liabilities. That means the impact of the transaction or the change of value which is on this side should be equal to the change of value on this side. Equal, no? Equal. If a value changes on this side, same value should change on this side. Alright? That's why here 100 plus and 100 minus, there is no change. Stock was bought, purchased, and cash was paid out. That simply means the stock which came into the business, for that same value, we paid cash. That means simply we can understand, children, there were no changes in the value of assets. Only the nature of assets changed. Instead of cash 100,000, goods came into the business. So 100 plus, 100 minus, no change in value. But here there is a change in value. 100 minus 125 plus. 25 is excess. What is that excess? What is that excess? What is this excess 25, children? It is the profit of the transaction. And profit belongs to the owner. Excellent. Profit belongs to the owner. And owners belongings should be put under equity. Here you go. Owner's equity increase with the profit. Was that understandable for you? I did it in the simplest way. Let's move on. Settle 50,000 of the bank loan. See, there's a bank loan here. And out of that bank loan, 300,000, settled 50,000 of the bank loan. Settled means, children, we pay out. We pay off the bank loan. Pay off. In this case, the cash 50,000 goes out, right? And the liability decreases because we are decreasing the bank loan amount by paying little by little. Settle 50,000 of the bank loan. Third transaction. 50,000 goes out, which means cash decrease. At the same time, liability also decrease. Bank loan liability. Bank loan liability. Because we are settling the bank loan. No? Is that right? That's right. Let's go on. Fourth transaction. Paid 100,000. No, that is 10,000. 10,000 as salaries. Paid 10,000 as salaries. That's a small salary, right? 10,000. Cash goes out. It is an expense. Cash decreases. Cash decreases. Because it is an expense. For transaction, paid 10,000 as salaries. It is an expense, children. Cash decreases. What is the next effect? You tell me. You son, you. Are you confused? No, right? So can you tell me, if 10,000 decreases from cash because we are paying the salary of an employee, cash decreases, that is so simple. We know that cash goes out, so cash decreases. But what is the next effect? If you did not guess, remember now. If you guessed equity decreases, that's correct. If you did not guess it, remember at this point, every expense decreases the equity. More expenses you pay, more things you spend your money, for more expenses you spend your money, lesser the equity gets. So something that should be specially mentioned, under equity minus 10,000. Under equity minus 10,000. Just check whether the sides are balanced. On this side minus 10,000 and on that side minus 10,000. Balanced, right? Balanced. Let's finish this off. Fifth transaction. We are half done. Sandamini withdrew goods at a cost of 20,000. Is that 20,000? Yes. Sandamini withdrew goods at a cost of 20,000 for her private use. Well, I did this in a previous exercise. Owner's drawings. Owner's drawings. Owner's drawings, children, drawings. But here, what drawings? What drawings? Sandamini withdrew goods. So these are goods drawings. Goods drawings. Owner coming and taking goods of the shop for her personal use. Owner just walks to the shop and takes the goods home. 1 kilo of rice and milk powder, packet of milk powder, and 2 kilos of sugar and some biscuits. Puts everything in a grocery bag and she takes the goods home. We can't say anything. She's the owner. What we do is, we tell her, madam, okay madam, you can take the goods, but the value will be deducted from your capital. The value 20,000 will be deducted from your equity. Equity or capital. So children, goods go out. That means stock minus 20,000 and equity minus 20,000. Drawings. Are we done? Oh, right. We are done with the first 5 transactions. We are done with the first 5 transactions. All right. So let's check, children, whether the transactions are done properly. Purchase goods at rupees 100,000 to sell. Purchase goods at 100,000 to sell. Purchasing goods means stock come into the business. That means stock plus and cash minus. Sold goods which were purchased at 100,000. So selling goods means goods go out of the business. That means stock minus and cash plus. Due to the profit which was made, it gets added to equity. Settle the bank loan. Settle the bank loan, 50,000. Cash decrease, liability, bank loan decrease. Paid 10,000 as salaries. Cash decrease, equity decrease, because expenses decrease equity. Sandamini withdrew owner's drawings, not just drawings, goods drawings. Stock decrease, equity decrease. All right. The next transactions. Sixth one, purchase furniture 50,000 for the use of the business. Purchasing furniture means furniture come into the business, cash goes out because we have to pay for the furniture. It's not Santa Claus who bring the furniture to the business. We have to pay and purchase the furniture. That means our children, we have a difficulty here. We don't have the headings, column headings. Column headers, we don't have. Let's put the column headers. Furniture, stock, debtors, cash. First of all, let's write our accounting equation. Assets equals equity plus liabilities. All right, column headers. Furniture, stock, debtors, cash. Under assets we have furniture, stock, debtors, cash. Under equity, under liabilities, bank loan and creditors. Is that right? Bank loan and creditors. That's right. So let's finish it off, okay? Purchased furniture 50,000. Furniture come in and furniture is here plus 50,000 and cash decrease, so minus 50,000. Right. Seventh, purchase goods at 200,000 on credit basis. Purchase goods means goods come in, goods increase 200,000 on credit basis. That is a problem. Here it says credit basis. Credit basis, which means, children, we don't pay. We don't pay for the goods. We just bring the goods. Okay? We bring the goods to the business, but we don't pay the money. Money doesn't go out. That creates what? Correct. That creates a liability. Liability. We should pay that supplier later. All right. So which transaction is this? 7th transaction. Goods come in 200,000, which means goods plus, okay, that is already here. Stock means goods, and is it a bank loan? No. Creditors. Creditors plus 200,000. In this case, children, credit basis means creditors. Credit basis means we have goods coming in to the business, but those suppliers are not paid. We haven't paid them, which makes them creditors. All right. 8th transaction. Creditors increase. Yeah. Okay. 8th transaction. Sold goods at 100,000 on credit basis. These goods had been purchased for 60,000. Selling goods. Goods sold. That means goods going out, right? Stock decrease. What is the value of goods? 60,000. So, goods decrease by 60,000 because the value of goods are 60,000. Oh, yes, we have sold for 100,000. That's a good transaction, profitable transaction. Profitable, yeah? Oh yeah, profitable. Sold for 100,000, but goods were valued. The real value of goods was 60,000, which means 60,000 stock decrease, 100,000 cash increase. End of story, yeah, done. Why? Why? What is the problem? That's wrong, yes. That's how you make mistakes. I have seen a lot of times when this type of a transaction comes, students make this error. Sold goods 100,000, the value of the goods were 60,000, so they decrease or minus 60,000 from stock and add 100,000 to cash. Children, notice this credit basis. Didn't you notice that? We did not get the money. That's what it means. We did not get the money. Didn't get the money. Sold goods for 100,000. Sold goods for 100,000, that's correct, but credit basis. Goods we sold, so goods decreased. I mean, goods went out. Cash didn't come in. The transaction was done on credit basis. Cash, no. That means you can't put this 100,000. $100,000 can't be here. No. Credit basis means, children, the goods sold for 100,000 was sold to a customer who did not pay us, then those customers become our debtors. Those customers become our debtors. That's right. So according to the 8th transaction, children, 60,000 goods stock decrease, but debtors increase by 100,000. It's not cash, it's on credit basis. Yeah, 100,000. And there's something else. Did you notice that? There's a difference here. There's a difference here. Yeah, 40,000 difference. When we go from 60 to 100, there's a 40,000 difference. That difference is what? Profit. Very good, very good. Profit belongs to the owner. Gets added to equity. Always check the balancing of the impact. There's a 60,000 impact here, 100,000 impact here, and there's a difference. The difference is 40,000. Okay, this 40,000, when it is added to equity, it's balanced. This side and this side balanced. The increasement of 40,000 has been increased here. Yeah, that's how it is done. Finished. Last transaction. 9th transaction. Received rupees 80,000 from debtors. Received rupees 80,000 from debtors. Received means cash increase. Received means cash increase. 80,000. Cash increase, yeah. From debtors. These are the debtors. Here you go. So these debtors have paid us finally. We have received money from debtors, but not the entire 100,000, only 80,000. That means cash 80,000 increase, that's done. Debtors 100,000 decrease. 100,000 decrease? No. If they pay 80,000, they should be decreased by 80,000. Is that all? No, there's one more. We'll finish it off. Paid 50,000 to creditors. Last transaction, paid 50,000. Paying means money goes out, cash goes out, so cash decrease. And we paid to creditors. Creditors are here, right here. Creditors also decrease. Simple, right? Don't you think so? Will you be able to do this type of a question if you get this on your paper? You need more practice? We'll do more questions, children. That's how we do such a question regarding the accounting equation. Now you learned how to record opening balances. Opening balances. We recorded opening balances, see? Opening balances. Right. and we recorded the transactions, the effect of transactions or the impacts of transactions. In some transactions you learn that there can be more than two impacts. 1, 2 and 3. There can be 3 impacts. With that, children, we wrap up today's session. We did the recording of transactions under the accounting equation with opening balances. With opening balances, that means in a business which has been carried out for many years, the opening balances or the assets, equity and liabilities which are already in the business, those values how to record at the start of a new year. That's what we did today. Hope to see you again with our next session. We will be doing more questions, more exercises from your textbook, and out of the textbook, model questions, targeted questions. That's why I expect to see you again. Thank you for being with me. See you soon.